We know that banks sort of throw these numbers out there to try to get these companies on board and get their business. How realistic is a $120 billion valuation?
Yeah, we'll have to. So, Uber raised from SoftBank at 54, so there's a huge increase from that. Toyota invested $500 million at 76. So the idea that we would see it somewhere, around 100 or above 100 isn't totally crazy, sort of at, going from 54 to 76. So 120 is possible, but like you said, the bankers are trying to convince Uber that they really see how big the opportunity is. So there's a level of sort of baked-in optimism to that number. So, is it in the range of possibility if the market's perfect and the story goes well and everything? Yes, but, will it stay at 120? I mean, I think there's no way to say.
Eric, we know that Uber is gigantic and it's a global phenomenon and all that. But then sometimes there are these stories like, oh, they need to get into scooters to find growth or food delivery or something like that. So it's still the basic question of whether this is a really strong cash-generating business. It's still up for grabs, right? Right.
We've never really seen proof that the ride-sharing business, sort of the core business, can throw off cash. And at the end of the day, that's what businesses have to do. That story has been made complicated because they're layering on, scooters, autonomous vehicles, Uber Eats, which, of course, when we then get to see the overall financials, means they're losing a lot of money. They've lost more than $11 billion. So, there's going to be this question whether they can sort of show that, the established business and ride-sharing they have is a good one, and then the losses that they're sustaining are justified because they're growing, these promising new businesses, instead of just muddying up the picture and making it hard to see that this is a business that really doesn't throw off much cash.
Yeah, not to mention autonomous driving and indeed flying cars. But let's talk about the junk bond. We've been talking about the equity side of the equation, Eric. What about the debt side? Because this really was quite a seismic move that they made in the debt market, deciding that they didn't need to have banks helping them in terms of syndication. They were able to pull in their own investor base. And the junk bonds, so a risky bit of debt, seems to be doing very well in terms of getting investors interested.
Yeah, I mean, Uber has these global investor relationships existing. I think, they are, one of their greatest expertise certainly has been raising money, to spend all that money they had to raise it. So the fact that they think they can go it alone, to me isn't that surprising, knowing the company, and they need cash to sort of get to the IPO and make sure that when they go public, they're in a comfortable place. It doesn't look like they're sort of going to run low on money. So it's, just a smart way to position themselves ahead of this dramatic public offering.